All right, guys, let's quickly take a look then at the RBNZ policy decision coming up tomorrow morning, nice and early at 3 a.m. UK time, and then the press conference scheduled for 4 a.m. UK time. Now, even though the press conference will be important, I think the trigger for the trade will come on the rate decision itself, whether they cut rates or hold rates steady. And then the focus will very soon turn to the OCR, because remember, what we get in this meeting, unlike the previous one that we had, is we get the updated monetary policy statement, their quarterly report. We got the previous one in May, and we get the updated one we get tomorrow. So I think the focus will be on two things. Firstly, whether they cut rates or whether they hold rates steady. I think that's going to be the main first trigger. And then the second one will be what they have to say about the rest of 2024 and the rest of 2025. How aggressive do they see themselves cutting rates this year and next? I think that will be the main focus point. Now, don't get me wrong. In terms of growth and inflation and unemployment rate, what they forecast for that is important. But what they forecast for that will basically just be a symptom of what they're expecting for this, right? So, for example, if this comes in much more dovish than what the markets are expecting, it's very likely we're going to see an upward revision that's aggressive for the unemployment rate and aggressive downward revisions for growth and inflation. If the OCR is more hawkish than expected, it's very likely that we're going to see not as aggressive upward revisions for the unemployment rate and not as aggressive downward revisions for growth and inflation. So yes, they will be focused on how bad they see growth getting, how low they see inflation getting, how high they see the unemployment rate getting. But the main focus will be this, because this will tell us how bad or how good they see all of these things getting, right? If that makes sense. So the main focus point will be whether they cut rates or hold them steady. And then the next focus point will be how aggressive do they see the OCR changing this year and obviously going into next. Now, in terms of where we are for this release, it's a tricky one because, consensus is split right now. If you ask the economist community, they say there's a higher probability that we hold rates steady. If you ask the shadow board or the NZIER shadow board, they would say that there's a slightly higher likelihood that we see rates being cut. If you ask money market seems the surest out of anybody right now. They are pricing in a 75% probability of a cut versus a 25% probability of a hold. Now, I still think that there's a higher likelihood that this bank remains on hold tomorrow. The only thing that I base that on right now is not just, we'll go through the data in a second. It's not just the data. Really, the only thing that I'm basing that on is how aggressive of a change it would be for this bank to go from just 3 months ago, expecting themselves only to start lowering the cash rate in the third or fourth quarter of next year, to then potentially bring that all the way up to the third quarter of this year. Think about how bad that looks on the optics side, right? This was only in May. It's only in May, right? So think about how bad that would look for the bank to say that, hey, remember 3 months ago when we said we're only going to cut rates, the third quarter, fourth quarter of next year? Well, we're going to bring that forward a whole year. That speaks of fear, right? That speaks of a central bank that was asleep at the wheel and now they need to make up for it, which I think that'll make them look bad, which is why I think I'm skewed more towards them not cutting rates. However, having said that, the one thing that is making me doubt my view is not the data or anything like that. It's the amount of press conference or press coverage that Governor Orr has scheduled for this week. After the press conference, we have Governor Orr scheduled for 3 different interviews. Now, you would think that he has something very important that he would want to explain to allow himself to be booked up so many times, right? So 4 speeches in 2 days, that seems a little bit aggressive, right? Or in 3 days, that seems a little bit aggressive. I think that if anything, that makes me uncomfortable about my view of a hold seeing how many times he scheduled himself in. For me, this looks like a governor that really wants to explain his decision, which could potentially be them cutting rates, right? So think about the optics thing that I said. 3 months ago, they said they're only going to cut end of next year. If they come out cutting tomorrow, they would have a lot of explaining to do, right? The media will be grilling them and drilling them, saying, hey, you said just 3 months ago that you're only going to cut next year, late next year. What on earth happened? And obviously you would want to give yourself enough time to explain to the public why you've made this decision, why you had such a huge policy error or policy forecasting issue just 3 months ago, and now suddenly need to bring cuts forward. So if anything, that is what makes me uncomfortable about my expectations of a hold, is seeing the amount of press coverage that is scheduled for himself, or allowed to be scheduled for himself. That feels a little bit aggressive. So let's quickly take a look at where we are. We know markets is split between how this decision will play out, but money market seems fairly clear. Let's take a look at the data. What about inflation? I mean, inflation slowed to 3.3% for the year-over-year measure, which was below the RBNZ's expectations, right? So it's moving closer towards that 1 to 3% target range. We're almost there. The big problem here and the big elephant in the room remains non-tradable inflation, right? Because that is still stubbornly high at 5.4%. However, the high non-tradables inflation didn't stop them from tilting more dovish in their language at that July meeting, the meeting we had last month. So that is something worth keeping in mind, right? So even though that is high, it didn't stop them last month. What about growth? I mean, recent data shows a significant contraction in economic activity. We looked at some of those measures last week. Doesn't matter where you look, things are looking pretty bleak. Whether you look at sentiment-based measures, whether you look at hiring intentions, investment, pricing intentions, it's looking pretty bleak. We have seen a sizable move to the downside. We had the performance of the services index, that PSI, dropping to basically global financial crisis era low. So it's been negative on the growth side. Labor has been a slightly more bright spot. The data last week was pretty solid. Yes, the unemployment rate increased to 4.6, but that was broadly in line with the RBNZ's projection. It wasn't worse than what they thought it would be. Wage growth has also slowed, but overall employment looked pretty solid in last week's report. So I would say the data, on balance, does open up the door for the bank to signal that they are going to cut rates this year. But I don't know whether the data is negative enough for them to want to cut rates already tomorrow, right? There's a big difference between those two. Taking a look at the data and saying, listen guys, we made a mistake in May. We thought we were only going to cut next year. We're going to cut this year. That makes a lot of sense based on the data. Them coming out saying, we had to cut today because we were asleep at the wheel. It doesn't sit right in terms of the optics. But, if they look at data like this, they would certainly have enough, there would be enough evidence for them to hold rates and cut rates. That's what I'm trying to say in terms of the data. So let's quickly take a look then at the potential scenarios here. I'm going to start with the consensus. Now, there's a few caveats to keep in mind about consensus here, because I'm going to put in the money market expectations here in terms of tomorrow. That is sitting at 75% chance of a cut, 25% chance of a hold. So I'm going to use the rate adjustment from a money markets point of view as the baseline expectation. When it comes to the OCR 2024-2025 expectations, though, there I'm going to be leaning more towards the previews that I've gone through this week, because even though money markets are fairly aggressive in terms of this year and what they're pricing in for next year, I mean, think about it this way. Money markets are pricing in close to 3.5 cuts for this year. That means a cut tomorrow, a cut in October, and then potentially a 50% price towards a 50 basis point cut for November. That feels a little bit aggressive, and there hasn't been one preview that I've gone through that suggests that that is what people are expecting. It seems like broad consensus is looking for something closer towards 2 cuts. Some saying they start tomorrow, then do another one in November. others saying that they announce one for October and then do a follow-up in November. So there are some who says they cut and some who says they hold. But whether there's expectations for tomorrow to cut or in October, the bottom line is 2 cuts this year seems to be consensus. In terms of the OCR for next year, there it's interesting because their consensus is more leaning towards what money markets are pricing in, which is about 5 cuts. Money markets are, to be fair, pricing in 5.5 cuts, or close to 5.5, while the participant previews that I've went through this week looks for something closer to 4.5, 5 cuts. So what does that mean? It means that for us to want to see a dovish reaction or a hawkish reaction, we need to see something that falls outside that range, right? Now, I've put it into words here, but I'll show you guys what that will look like as a mock change to the OCR in a second. So just bear with me. Let's start with a dovish outcome, right? For a dovish outcome on the rate adjustment side, obviously a cut would be a surprise. It won't be as big of a surprise as a hold because the markets are only expecting a hold at 25% probability. So obviously from a surprise factor, the hawkish side of this outcome will see a much greater reaction compared to a cut. But because the market is so divided on this, it's just money markets that's not divided, right? The economist community is divided. The participant previews that I went through were divided. The markets aren't sure what's going to happen. So even though we are already 75% priced towards a cut can still see negative reaction in the Kiwi. It just won't be nearly as big as a hawkish reaction would see upside. Also keep in mind, positioning moved back into stretch short territory for the Kiwi dollar, right? And we have seen a ton of downside for the Kiwi in the last couple of weeks as well. So we need to keep in mind that, you know, from both a positioning point of view as well as an expectations point of view, a cut won't be as big of an impact compared to that of a hold decision tomorrow. In terms of a dovish outcome for the OCR, because the broad consensus is looking for about 2 cuts this year, 3 cuts or more for this year will be pretty aggressive on the dovish side from the bank. And on the hawkish side, 1 cut or less this year, right? So that puts us around 5.3. The reason why I say 5.3 here and like 4.3 here and 3.8, the reason why I'm not saying 5.25 or 4.25 is because the bank rounds their numbers when it comes to the OCR projections. Over here, right? So you use 5.6 and 5.7. So with that in mind, I've just rounded it to make sure that we stay fairly close to those conventions. It might not, it might be, you know, it might be 5.2 or 5.4, but 5.3 puts us fairly close to that range, if that makes sense. The bottom line is 1 cut would be seen hawkish and 3 cuts would be seen dovish. In terms of the OCR for 2025, 5 cuts seems to be the consensus, meaning that 4 cuts or less for next year will be seen as hawkish, and then 6 cuts, potentially more even, would be seen as very dovish for the OCR. Now, what would that potentially look like? So again, OCR is going to be the main focus, right? So if that comes in super dovish, you expect these things to reflect that dovishness. If this comes in more hawkish than expected, you expect these things to reflect that. So I'm only going to focus on the OCR. So what we have here is the OCR May update that we had, right, for 2024, 2025. It seems like we said, broad-based consensus is expecting 2 cuts this year and 5 cuts the next. Meaning 2 cuts will take us down by the end of the year to about 5%, right? And 5 cuts then priced for next year takes us back down to about 3.8% by the end of next year. So assuming we get the dovish type of outcome, which is looking for 3 cuts this year and 6 next, that puts us closer towards 4.8, 4.7-ish, right, by the end of the year, this year. And it puts us closer towards 3.3, 3.4% by the end of next. So that'll be a very dovish change in terms of the OCR. For a hawkish one, it'll only reflect 1 cut this year and 4 cuts next, maybe even less next. But let's stick to 1 and 4. 1 which would take the OCR down to about 5.3, 5.2. And 4 cuts next year will take us back down to about 4.3%. Now remember, the way that they will slot these in isn't necessarily by quarter, but by how many meetings they have within those quarters. So what I mean by that is don't look at it as a stepped feature in the quarters. You need to understand how many meetings there are. So for example, if you take a look at the March quarter, the reason why you would only expect one cut in that quarter is because there's only one meeting scheduled for that quarter, which is the February one. If you compare that to the second quarter, there you have both the April as well as the May meetings falling into that. The third one, you've got both July as well as August, and then obviously for the last one, for the fourth quarter, you've got that October meeting scheduled. So you're basically looking at a scatter, one meeting scheduled for Q1, one meeting scheduled for Q2, but you get two meetings scheduled within those two, which means that's why you have a bigger jump between the first and the second and the third and the fourth, if that makes sense. So that is a possible dovish outcome. That's a possible hawkish outcome in terms of the OCR. Again, I think the main focus point for the markets, yes, the language matters, right? But the reason why I didn't give you guys examples of the language change is because that will be reflected in the decision to either cut or hold, and that'll be reflected in how aggressive they change the OCR. If the OCR is super dovish, they are going to sound dovish about the labor market. They are going to sound dovish about inflation and dovish about growth, right? And vice versa if it's slightly more hawkish. So we just need to keep that in mind. I think the main focus will be those two things, whether they cut or hold and how aggressive they are with their OCR projections. So coming back to the trade plan then, if it's an inline outcome, look, an as expected outcome should already be seen as dovish by the markets. Why? Because not everybody expects the bank to cut. So if we do see a cut in line with money market expectations, and we do see 2 cuts priced this year, 5 next year, even though that is in line with broad expectations for the markets, that will still be seen as a dovish shift from the bank versus what we got back in May, a quite aggressive one at that. So that could still see some downside for the Kiwi, but because positioning is so stretched right now, because we've already seen a lot of downside, I won't have enough conviction to want to chase the Kiwi lower on an as expected outcome. Don't get me wrong, if we cut, it could see that initial spike lower in the Kiwi, and that could well be tradable. But for that type of, if you really think they're going to cut, you would probably want to be short the Kiwi going into it then. And I just don't have conviction to do that, right? So just keep that in mind. If it's an as expected, it could still be dovish, and that could still see downside for the Kiwi. But that's probably the type of trade you want to be positioned ahead of time with. You don't want to be taking that shot, on the decision, because then you would have to have other dovish things to give you conviction to want to chase that. So assuming we get a very dovish or hawkish outcome, what can we look to trade? I'm going to keep it simple and pick Aussie Kiwi for both dovish and hawkish outcomes. Why? It's a good differential pair to use. It's a pair that normally trades very well, very aggressively when there's big policy divergences taking place between the likes of the RBNZ and the RBA. So you can look for it on the long side on a dovish outcome and short side on a hawkish outcome. In terms of possible areas to target for that, for the Aussie Kiwi, the most obvious targets to the downside on a hawkish surprise would be the recent lows, right? Coming in around that 108.60, 108.50 psychological levels. Those are key levels to watch out for. Also comes in close to that other level just below that 108.30. If that folds, the next key area of support comes in around that 107.80-ish level. So really key areas to aim for to the downside. To the upside, recent highs marries up nicely with today's implied volatility as well, coming in at around that 109.80 level. Above that, you also have the 110 with that spike high going back to the 6. And then above that, you've got those recent highs going back to 110.200. So key levels to aim for to the up as well as to the downside for that. The other one that I've added in there, in the event that we do get a very hawkish outcome, is potential upside for Kiwi Swiss. We know that the SNB won't be liking the amount of strength that we've seen for the Swiss franc in the last couple of sessions, and let's just call it 2 and 3 weeks now. And The Kiwi Swiss has put in a solid V bottom here. We are just breaking, slicing through resistance after resistance after resistance. Momentum has turned pretty bullish here in the short term for the Kiwi Swiss. So looking for a possible move back up towards 52.80 could be on the cards. That's the spike low going back to the 18th of April. If we manage to clear that and break back above it, it would probably be one of the most aggressive false breaks we've had, for this pair in a very, very, very long time. So that could potentially, set up for an even greater move, maybe back up towards 54 psychological. But again, preference would still be Aussie Kiwi, but Kiwi Swiss is also one to maybe keep on the radar. So to quickly just recap, main focus points for me will be whether they cut or whether they hold. That's going to be the first trigger. And then it'll be how aggressive they shift the expectations for the OCR, looking towards a more dovish outcome. And this is looking towards a more hawkish outcome. As always, keep in mind, it is happening in the midst of the Asia Pacific session. What does that mean? Crappy liquidity, crappy volumes, which means your spreads are going to spike like crazy. You're not going to get great fills if you try and if you're going to be buying the Aussie Kiwi, for example, on a dovish decision, you're probably going to get a bad fill because you're going to get a spread spike. You're going to get if you trade immediately out of the decision, it's going to be messy. It might be worth just if you can, maybe give it a few seconds to see if the spread calms down and then get in. The risk with doing that, though, is that if you take too long to press the button, you might get a bad fill anyway because you waited too long. So it's a little bit of a trade-off there. It's something that you'll just need to navigate it in real time. Just know that your spread will be bad, your fill will be bad because it is Asia Pac. That means also that your preference would be more for a hawkish outcome, because then you can look to short something like the Aussie Kiwi because you won't be filled at your ask, you'll be filled at your bid, which means that you'll be filled fairly close to where you press your button, obviously depending on what type of slippage you get. And then you just need to wait for the spread to calm down, but your fill won't be horrible, right? So to put that into, what I mean with that is, let's put that into practical terms here. Imagine that you get imagine that it's a very dovish reaction. You get that first initial spike to the upside. You won't get filled there on that first candle because if you have your ask somewhere over here and your bid somewhere over here at that time, right, you might only get filled somewhere over here. Because you get filled at the ask, you don't get filled at the bid on a buy. Where if it's a short trade, right, if it spikes lower like this, you're going to get filled at your bid, which should be somewhere over there, but your ask might be, somewhere over here at that time. You don't have to worry about that because if you get filled over here, you basically just need to wait for that to calm down, and then wherever you got your fill, once this spread closes, then you're going to be okay in terms of where you fill. So a short's normally a better idea compared to a buy. Doesn't mean a buy is impossible, just means that it's you have to keep those types of things in mind based on the liquidity that you have at that time of the day. So just keep that in the back of your minds then. All right, guys, so that is a preview and a trade plan for the RBNZ. Let's hope we get some real shockers to give us a good trade out of that event.